Okay, so we are speaking about the capital structure. So we will first understand what is weighted average cost of capital and what impact it has on the value of the firm. Okay. So first, when I speak about capital, we can arrange capital in three ways. One is debt, one is equity, and one is preferred stock. All this particular capital structure, all these particular sources of finance, what I mentioned here, okay, has a cost. So I represent the cost of debt as KD. I represent the cost of equity as KE. I represent the cost of preferred stock as KP. Cost is nothing but what the investors require the return from the company, okay, which is arranging for finance or which is raising capital in any of this form. Okay. So cost of debt, cost of equity, and cost of preferred stock. See, if a company is going for all debt finance, cost of debt is the only cost for them. If a company is going for all equity, cost of equity is the only cost for them. If a firm is going for all preferred stock, cost of preferred stock is the only cost for them. But if I tell you they are going for a combination of debt plus equity plus preferred stock, let's say cost of debt is 8%, cost of equity is 14%, cost of preferred stock is 9%. Okay, but if they are going for all the three, the combination of debt, equity, and preferred stock, in that case, what will be the cost of capital for this company? For company X, which is going for the combination of debt, equity, and preferred stock. So in that case, we want one single rate, right? That one single rate, if we want to find out, we have to use the concept of weighted average cost of capital. Fine. Now, what is this weighted average cost of capital? We will be giving the weightage based upon the proportion of each and every source of finance in the total capital. Now, how are we going to give the weightage? Let's say 10 lakhs is the capital which I have arranged. In that, the debt finance is, let's say, 2 lakhs. The equity is, let's say, 6 lakhs, and the preferred stock is, let's say, 2 lakhs. So all in all, this is 10 lakhs, and the cost of debt is 8% KD. The cost of equity is 14%, and the cost of preferred stock is 9%. Okay, you're following, right? Now, how to find out the weighted average cost of capital? So the formula for the weighted average cost of capital would be like debt by debt plus equity plus preferred stock, proportion of debt in the total capital. So 2 lakhs is how much of 10 lakhs? I will say that is 20%. Okay, so I take in decimal 0.20 into cost of debt. And the debt, if you arrange debt finance, you have to pay interest as an expense, and that can be claimed as deduction, which will be reducing your tax liability. So the net, you will be getting some savings in that case. So in the net cost, always we will take as 1 minus tax rate. Okay, so debt is always taken after deducting the tax part. Okay, because that much you are going to save. You're not going to you are going to save your tax liability with the help of interest. How? See, my taxable income, it is 1 lakh, and I pay taxes at the rate of 30% is 30,000. But I claim deduction of my interest expense for taxation purposes. So my 10,000, if I deduct from this, my taxable income is 90K, and my tax I pay is 27,000, 30% of this. So I'm saving 3,000 in this case. So my net cost, if it was 30, if it was 10,000, my saving is, if I put this as minus, my saving is 3,000. So my net cost is 7,000. So you understand that I take only 7% in this. So 10 into, let's say this was my example. Here I take 0.08 into 1 minus 0.30, the tax rate, plus equity by debt plus equity plus preferred stock into cost of equity. So I know equity in my total capital is 60% plus 60%, 0.60 into 0.60 into where is that, 14% into KE 0.14 plus The preferred stock is 20%, 0.20 into preferred stock is 9%, 0.09. Now you can do the calculation of this. Just a second. Okay, you parallel do the calculation from your side also. To 0.70, 0.056. So 0.0112 plus okay 0.084 plus 0.018. We will add up all of them and multiply with 100. We will convert them to into percentages. So 11.32 is our WSCC. Okay, please make a note of this concept fast. I'll give you a question to solve or we'll solve it. Just take your time, please. I'm waiting fast. Okay, just do this question. So ABC Inc.'s capital structure is 50% debt, 50% equity. So here they are, having a combination of capital, a combination of debt and equity as capital. So ABC's cost of debt is 8%, while the cost of equity is 11%. ABC's corporate tax is 30%. Asking to calculate WACC. So we'll take 50% debt into 0.08 the cost of debt into 1 minus tax rate plus 50% equity into cost of equity, and we do the calculation, we get 8.3%. that is our WACC. One thing you should understand, if the WACC is increasing, it will decrease the value of firm. If you take a company whose future cash flows you are expecting from operations, those cash flows, if you discount with a higher discount rate, okay, it will give you lesser value of that firm. So value of the firm will decrease, and if WSCC decreases, value of firm increases. Because the lower the discount factor, the more the value for the firm, because less discounting happens. Okay, now let's go ahead with the next question. Explain factors affecting capital structure and WSEC. So capital structures vary considerably among companies. Of course, not every company will have a similar kind of capital structure, even though the company have similar kind of businesses. Typically, a company will target a capital structure that minimizes its WSEC. That's what I said. So company should always look forward to minimize their WSEC, and that will enhance or increase the value of the firm, while also considering the nature of its assets, that is long lived or short term. See, they have to consider what kind of assets, what kind of assets they want in their business, and how they should be looking to buy them. Okay, based upon that they will be arranging the capital and they'll be trying to buy. But they always try to minimize the weighted average cost of capital. If you have pool of, if you have different types of sources of finance, when choosing the duration of its financing sources, that means long term or short term, they have to look. We may view factors that affect capital structures as those that determine a company's capacity to service debt. See, every company, which wants to start its operation want capital. Capital, they would be looking for the capitals what they want, but not always they would be getting what they would be wanting, because their profile should kind of, their profile should match their eligibility for getting the finance. Okay, so they may sometimes only get debt, sometimes they can get equity, sometimes they may not be able to fulfill their entire requirements of capital with the help of equity, then they'll go for debt finance or combination of debt and equity. So it depends. Okay, so these factors may be internal or external to a firm. The internal factors include characteristics of the business or industry. What kind of company, what kind of business it is, what it is operating in, which kind of industry, and what is the type of finance which that particular company would be getting, being in a particular kind of industry. Okay, and they will also see the company's life cycle stage. Okay, company's existing debt level also is considered. Just give me a second. And the corporate, what is there, if they already have debt finance, so that debt finance they have to what extent. And the corporate tax rate also. See, debt, why companies go for debt is they can claim interest as deduction. They have a good benefit. But debt is also a cheaper source of finance. Debt is easily available, but debt creates a higher risk. Okay. So again, external factors include market and business cycle conditions, okay, regulation and industry norms. So all these factors are very important to decide the capital structure. So if there is high regulation, it becomes tough for them to raise the funds through equity, because they have to fulfill lot of regulatory requirements. Okay, and what kind of business it is, and business cycle, they have to check of how many years the business cycle is, or for that company. And accordingly they will be seeing what kind of capital they should be going for, long or short or whatever. Okay, So all these factors are important to be considered. Companies characteristics that influence the proportion of debt capital structure include the following. So the operating or running, okay, it has some characteristics, right? Something is typical of that company, and then if at all they may arrange capital for themselves. Okay, I'm speaking about the company. So like what are the factors that may attract debt finance, okay, or the influence of the debt if it is arranged for a company, what it can be, okay. Or if the company goes for debt finance, then like how it will be impacting them. So companies characteristics that influence the proportion of debt. See, companies have certain characteristics or something is typical about a company, so they will be, it would require debt finance. And if they take, then in a company's capital structure include the following: growth and stability of revenue. So high growth of revenue or stability of significant revenue suggests a continuing ability to service debt. That's what. If the company goes for debt finance and it arranges debt for themselves, so it is not not a worrisome thing. But company should always be a good performer so that they can easily service this debt or pay off this debt, which is a combination of principal plus interest. Anything which is defaulted amongst any of these two is nothing but gives the tag to the company of a defaulter. So they should be paying off this one. So growth should be there in the company. High growth of revenue, they should be more stable, and it is very important for them that this should be there, and then only they can pay off the debt. Then growth and predictability of cash flow. Growing cash flow increases the ability to service debt. It is a well-known fact. If you have good cash flows coming into your business, you will find it easy to pay the debts. Otherwise, you will struggle. Significant and stable cash flows indicate a continuing ability to service debt. Amount of business risk. More business risk. Okay. More business risk, that is operational and demand risk. Business risk is all about threat of new entrants entering into the market, bargaining power of suppliers, bargaining power of customers, and close substitute to the products in which we deal. So if higher business risk is there, that means more variability of earnings and cash flows, which decreases the ability to service debt. That means more variability, less stability. More variability or less stability in earnings can make it difficult for the company to pay debts or repay the debts. Then amount and liquidity of companies' assets. So assets can be, pledged as collateral to make companies' debt more attractive. When assets are more liquid, they can be pledged more readily, easier to turn into cash, values more stable. Of course, see what happens if you're looking for debt finance, you can easily get debt, okay, by pledging your assets as collateral. And then you can easily get debt finance, and the assets which you are pledging should be more liquid, because banks look at such assets which can easily be converted into cash. Okay, those are more easily pledged. Cost and availability of debt financing. See, companies find debt relatively more attractive when the cost of debt uh, is lower and investors are more willing to lend to the company. So companies find debt relatively more attractive. Okay. See, of course, why? Because they may get it at cheaper. rates, and the cost of debt is relatively cheaper when compared to cost of equity. It is more stable, from the investor's perspective. It is stable. Company only looks for cheaper source of finance, so debt happens to be a cheaper source of finance for them, and also that can help them to claim deduction for interest expense and save lot of cash by reducing their tax liability. And companies find debt relatively more attractive because of that. And when the cost of debt is lower, and investors are more willing to lend the company. In general, more stable, very important points, predictable and recurring are a company's revenues. If a company's revenues are more stable, more predictable, that is more certain and more continuously coming, the flow is continuously there, and cash flows, the higher proportion of debt it can have in its capital structure. With this in mind, we can say other things equal. So if this all things are there, they can look for higher proportion of debt finance in their capital structure. They can either go for 60% debt and 40% equity also, if this is always there very strongly. Companies in non-cyclical industries, whereby there's no cycle for the product to start from one place and end, and again new product has to come, are better able to support high proportions of debt than companies in cyclical industries. Because in cyclical industries, again they have to start afresh or new, and they again want debt finance. So non-cyclical industries are better able to support high proportions of debt because they are more stable ones. It is never ending process for them. See, the business goes forever, so they are more stable, so they can pay the debts more easily. Companies with low fixed operating costs as a proportion of total cost. So total cost is a combination of variable cost plus fixed cost, and fixed cost again I will divide into two types: fixed operating costs and fixed finance cost. So companies with low fixed operating costs as a proportion of total cost are able to support high proportions of debt than companies with high fixed cost. Of course, if the fixed cost is less for them, they of course will be more willing to take higher proportions of debt than equity. Okay. See, equity also has certain side effects. Very high equity is also not good. Very high debt is also not good. Balance equity and balance debt is good. Very high debt, in the sense the debt covenants, lot of restrictions on the company to take additional capital in form of debt finance, and it also leads to bankruptcy risk. Okay, and you have to be a consistent performer. So very high proportions of debt in the capital is also dangerous. Very high equity, the shareholders will always want to pressurize the management and directors to do to act based upon their wish and will. Okay, rather than the way the things are to be done. So that is also not good. So activist shareholders will put immense pressure on the company's board, and there will be conflict of interest always. Okay, that is not good for running the organization. So companies with low fixed operating costs as a proportion of total cost, that is low operating leverage, I already told you here, are better able to see where if you have less fixed cost, that is always good for your company, right? Than company with high fixed cost. See, variable cost is not something to worry about. Variable cost depends upon the activity levels. More higher the activity level, higher the variable cost. But fixed cost is very dangerous. If even though you perform or you don't perform, fixed cost has to be paid. So it is better you should be performing on a higher scale. That means generating more higher revenues, so that this fixed cost would look like peanuts to pay. Companies with subscription based revenue models like Netflix are better able to support high proportions of debt than companies with pay per use revenue models like picture theaters. Okay, because subscription based revenue models, they know that they have some fixed amount of money coming to them. Here the it is not stable. All the tickets of the theater of the movie on one particular day will not be sold out. But in subscription based model, they know like how many people will subscribe, and once they subscribe, Yeah, we understand 10% people may leave the subscription, but they know 80% of the people are going to continue with them, and that's what they're going to continue. Every month they will be making the payment, so it becomes easy for them to service or pay off their debts. Now, type, just a second. So types of assets companies use to generate revenues also affect their ability to issue and service debt. For example, creditors tend to view tangible assets as better collateral than intangible assets. Of course, see what kind of finance you want to arrange. Okay. And if you want to go for debt finance, it is easy with tangible assets. You can keep that as collateral. Okay. So the types of assets companies use to generate revenues. So more tangible assets like a factory, if you are talking about a manufacturing concern, it may have big equipments, machines. If we talk about a service firm, it may have just one computer, one desk, furniture, one air conditioner, and all. So here this see the revenues may not have much difference maybe, of course, but here the cost of setup is very high. Here the cost of setup is very less. Here all is intellectual. Here all is based upon machines and production. Okay, so creators tend to view. So if at all someone has to give loan, they can they find it easy to give loan to this company because they can keep the assets with them as collateral. Okay. So here the assets, here they have more tangible assets, here more intangible, because technical know-how, skills and all are intangible things. You can't touch them, and there's no physical substance for them. And if necessary, without losing significant value, are more liquid, or are more readily substituted for similar assets, that is more fungible. So a company that owns its productive assets outright as opposed to using assets owned by others, such as franchisee model. So company that owns its productive assets outright as opposed to using assets owned by others has more collateral, which improves. So if you have your own assets, that means it is more easy for you to get debt finance, which improves access to debt financing and reduces borrowing cost. In addition to types of assets, other issuer specific conditions, what the issuer has to fulfill certain conditions to get the debt finance more easily, include the levels of existing debt, what kind of how much debt they have already, and there will be more volatility of earnings and revenues. High levels of debt or high volatility of earnings indicate lower ability to issue additional debt. So if your earnings are more volatile, that means less revenues your earnings you are generating, because you have more expenses now in form of interest. So it will be tough for you to get more additional debt. So leverage, that is debt to equity or debt to operating profit, and coverage, that is interest PBIT by fixed interest charges. The companies would be looking at the leverage ratios, that is how much debt to equity company has, and what is the interest coverage ratio a company is maintaining. So here I would say 6 to 8 is ideal. Okay, in some analysts say 3 to 5 is also ideal, and here 1 is to 1, 50% debt, 50% equity is good. Okay, we can see the effects of these various factors on debt to equity ratios of companies at different stages of their company's life cycle. Consider the following three stages. So startup stage, growth stage, and maturity stage. These are the three stages a company has to pass through. So sales are just beginning here, and operating earnings and cash flows tend to be low or negative. See, in startup stage, they have just started a business, right? So the sales have just beginning for them, and they are generating operating revenues and cash flows. Okay, these are very low during the early stages. Business risk is relatively very high. Company debt is quite risky, and if issued would require high interest rates, because at the startup stage they want more interest. The lenders will demand more interest. Why? Because they find this stage to be more risky. And the reasons are given here, because the earnings are more volatile, less earnings and revenue are seen. Okay, assets, both account receivable and fixed assets typically are low, because less sales, so less cash sales, less credit sales, and less what we say, when the less sales are less, you would be maintaining less inventory, so less fixed assets, less go downs. Therefore they are not available as collateral for debt right now. For these reasons, startup companies are financed almost exclusively with equity. So they look for investors, angel investors, venture capitalists, etc. In some cases, high growth companies with rapidly rising stock prices may find it possible to issue convertible debt. So some cases, some high growth companies whose stock prices are going up, they may like issue bonds to people and can easily raise funds, which allows company to use lower cost source of capital and avoid immediate dilution of existing shareholders' interest. So what happens if some company which is a startup is doing well, very well, so now then at times what happens, it is easy for them to raise finance, and with that what would happen, the cost of the debt is less when compared to equity, and the dilution of EPS is also less, because more debt, less number of shares, and less number of shareholders, and the profit, let's say if a company has $100 as profit, 50, and it has 10 shareholders, so each one is getting $10. But if you see a company with $100 of profit has only 5 shareholders, that means 50% equity we are using, and 50% of the funding with debt, 50% equity is 5 shareholders, let's say. So each one is getting $20. So here there is more dilution, right? More number of shareholders. So with debt finance, what happens? The dilution is less. So the shareholders will get more share of profit. So leasing is also one of the options in it is also one of types of finances. Okay, which is available for the companies to take tangible assets for their own usage. Then comes the growth stage. Revenue is, slightly rising here. Just a second, just a second. So growth stage revenue and cash flow are rising now. Business risk is somewhat reduced because the firm is, more established in the market now. Debt financing cost is somewhat reduced. Okay. because when the business becomes more stable, the lenders are ready to lend to the company at cheaper rates. Okay, and the usage is more conservative here. Okay, like putting more money into long-term assets. Okay, and using long-term financing more here. Okay, and investors may be willing to lend to the company, often with loans secured by fixed assets or accounts receivable. Comes the maturity stage, the revenue growth is slowing right now because they have reached the peak. Business risk is much lower because they are established one. Cash flow is significantly relatively stable. Revenue growth will slow, cash flow will be more stable. Businesses will be less. Debt financing, including unsecured debt, is widely available at relatively low cost because now they are a very established firm. So less security. If they don't give security, in some of the cases, they may get loans also, seeing their strong profile. Cost of capital is also influenced by top-down factors. Top-down factors are macroeconomic factors that affect the benchmark interest rate, that is US Treasury rate, and credit spreads to benchmark rates. Credit spread is nothing but the difference between the government lending and the private. Just a second. Yeah, so macroeconomic factors like benchmark rate is increasing or decreasing, then that may have an impact on the interest rates, and also the credit spreads to benchmark rate. So benchmark rate is treasury rate, and there can be a bond of some other company. Okay, let's say that is ABC company. Okay, this is 5%, this is 8%. The difference between them is called credit spread. Okay, so the yield of a risky bond, this is a risky bond, minus the yield of risk-free bond. Okay, so here the difference is 3%, which is 300 basis points. So if the spread is more and more broader, more risky. If the spread is less broader or more narrower, that is if the difference is 200 basis points, more better. This is more secured because it is more moving towards the benchmark. And because of various factors, the spread can increase more. This if the spread is high, there is more risk. Okay, widening spreads more uncertainty, more higher default risk chances of economic downturns. Narrowing spread, more stability, less reduced risk. Less risk, high risk. Important concept spread, always try to remember. These include inflation, real GDP growth rate, monetary policy, and exchange rates. In business cycle downturns, debt investors demand higher yield spreads to benchmark bonds. When the business cycle is, going like, is not good for a company, then the investors will require more returns. So the spread will widen. Okay. Because they want more returns, because they want to get compensated for taking a higher risk of default. This is especially true for companies in cyclical industries. Some industries may be favorably affected by economic environment. For example, oil industry profitability is linked to oil prices, and spreads for issuers in the industry tend to narrow when oil prices rise. When the oil prices are going up, the risk reduces. The risk reduces, the spread narrows. Okay, the risk is high, the spread is broader or widening. So I'll just take a small break. Okay, and then immediately we'll continue with the same session. I'm not stopping here. I want to take up the next topic also. I want to take up the uh, you know, theory explanation regarding capital structure. I will finish that and or else try to finish the entire thing only. Okay, I'm in a mood of finishing this, fine, so that I can start new topic. I'm taking a small break. We'll be back. Okay, just give me a 5 to 10 minutes break. Thank you. I'm messaging you.